All right, welcome everyone. Happy Thursday. This is the Wealth Management Show. Today we have a special episode with special guest Justin Spire. He's a CPA with MBAF CPAs. He's our tax specialist that he's going to be sharing his knowledge, and we're going to be discussing some end of year tax planning strategies. We're going to be discussing what you might be thinking about, what you maybe should be thinking about with the upcoming tax changes that may or may not be on the horizon, what would be smart to do anyway, regardless of what might happen in the future. Those are exactly the things we're going to tackle today. And as usual, how does it tie into wealth management? So welcome. This is the first step in advanced wealth management and wealth planning is the education side. That's why we do these streams. When you elevate your knowledge, more is possible because you understand more of the process, and you're going to be much more willing to and much more excited to, frankly, engage in advanced strategies and topics. So, good on you for being here. This is, again, like I'm saying, the first step, and it's the reason we do the stream, to sort of elevate your knowledge, help you understand more of what's going on, and so that you could utilize all these tools that we're always talking about. Like I mentioned, wealth management is sort of an emergent property of many different things, ideally handled in synchrony, right? Tax planning, estate planning, things like asset protection, financial planning, portfolios, right? All of these things come together, and the emergent property is sophisticated wealth management. So today we're going to focus on that area of taxes, since we have our CPA guest, Justin, with us. And he's going to be able to share, a lot of the knowledge that he has, insight into what are people thinking about right now, what is being done right now. So take advantage, ask questions. Anybody joining us on Facebook, please hop on over to the YouTube link, give us a like, give us a subscribe. We're slowly now going to be transitioning. I know our initial audience and this stream grew through Facebook Live, but the stream quality, the replay accessibility on the library on YouTube is much, much better. So do us and do yourselves a favor. Come on over to the YouTube link, and we'll see you there. The exact same broadcast takes place simultaneously. As usual, again, I'll be keeping an eye on your comments. Any questions you had, like I just mentioned, it's tax day. Try to take advantage of the fact that we have Justin here with us, and any concerns you have. There's a lot going on, and like I said, a lot potentially on the horizon. So a quick intro of myself. For those of you who don't know, I'm co-founder of Rushlight Investments and private wealth manager, and my job is keeping the 30,000-foot view on your biggest goals of retirement, lifestyle, philanthropy, the next generation, and that sort of thing in full focus when it comes to all these moving parts. Instead of handling things in isolation and doing good things over here, good things over there, we make sure everything's beautifully working together. And the sorts of conversations that I have with other professionals, you sort of get an insight into how they work through these live streams. It's our casual format that we bring to you guys, where you're sort of, you get a seat in our home offices, and you get to see what's going on and listen in and participate if you'd like. So our guest, a little bit more about our guest, Justin, he's Senior Tax Manager at MBAF CPAs. The reason we have him on is he specializes in high net worth individuals and that have a domestic and international footprint. So that's the sort of niche area, which is exactly sort of the topics and the client types that we target and we talk about on these streams. So it was a very natural next step to bring him on. And this is sort of a nice evolution in some of the previous topics we were talking about that will come into play indirectly. We've had guests on estate planning. We've had guests on asset protection. Today we're going to be talking taxes. So we're covering all these different areas, and we will continue to do so in a more advanced way in the future. So I'm excited that you're here. Again, anybody watching on Facebook, come on over to the YouTube page, ask any questions you'd like, and we're glad you're here. With that being said, let me move on over to the dual screen so you guys could see our guest, Justin, here. And I hope I did the introduction justice, unless there's anything you'd like to add. But this is our good friend here, Justin, and like I just mentioned, we're going to be tackling some end of year tax topics today. What should be on your mind? What are high net worths thinking about? And what should they be thinking about if they aren't considering it right now? There's a lot going on potentially on the horizon due to upcoming tax changes that might happen, sunsets on current tax laws, regardless of what happens next year. Those are the types of things we're going to be talking about today. So, Justin, I guess, how are you, man? How are you doing today?
Doing great. No, thank you. Thank you again. Thanks for the introduction. Very well. You put it perfectly. And, doing well and here comfortably from home, I'm sure as all of you are. And especially it's been an interesting tax season this year, completely being remote and having everybody remote. But
Yeah.
yeah, I guess we can kind of get started into, what's on the horizon. I mean, the
Right.
big thing with tax right now that we're looking at is what's going to happen in Georgia coming in January. So that's really going to be the pivotal moment to decide, how quick and how fast these potential changes that President-elect Biden is putting into place. So I know the first one we're kind of going to talk about a little bit during presentation, not steal thunder a little bit. We're going to talk about different strategies, three different ones that with various different risk levels, because sometimes these reforms might or might not pass. So you have to be aware of that when you're making your plans. And in addition, you always want to have as much flexibility in your planning as possible. But we're going to go through in order of risk, being the first one for gifting being not as a risky strategy, and we'll get into the reason of why that is the case. The next thing we're going to talk about today is also about the Roth conversions. And if time permitting, we'll talk about the new recent tax rate changes on different entity types and ways you can do business. So without further ado, let's get into the gifting. Let's get into this. So this has been a major talk on a lot of people's minds right now about the whole gifting exemption. And the fact of the matter is that right now we have historically high unified federal gift and estate tax exemption of about, right now it's 11.58 million. So what does that mean? That means that let's say you have an estate that's over this amount and you haven't made any previous gifts. This is an opportunity for you to exclude 11 million of your assets into out of your state and put it outside your state. Like for example, typically what we see clients do is open up a trust structure, which is probably might have been discussed on the estate planning call, opening up trust, putting assets into a trust. And right now, because of COVID, valuations are actually going to be at historical lows. So this is an opportunity to not only take advantage of a high exemption, you're also taking advantage of lower valuations, and thus you can get the assets into outside your estate at a lower value. And while the assets are outside your estate inside of a trust structure, they can grow completely, they can grow outside your estate and not be subject to any the estate tax when, let's say, you pass away. So all that appreciation that you get from it being inside of a trust will not be reflected on your gross estate. So when you pass away, that's assets. That could be, for example, you could have a startup company that could be worth like, close to like 5 million like right now in shares. And then when you pass away, it could be worth hundreds of millions. So that appreciation that you're getting is happening completely outside of your estate. Now, what President-elect Biden is looking to do is to accelerate this sunset provision, which is in the code, which is due to expire. This high exemption is due to expire in 2026. Because before it was about 5.5 million. So in 2026, regardless if Biden doesn't do anything, it's going to go back. It should go back down to the 5.6 unless someone else comes along and expands this 11.5. However, there's talk of accelerating that so that in the following year, this particular exemption could go back down to 5.5, and thus you could lose out on potential savings or potential future savings or future opportunities to push assets outside of your estate.
Right, right.
Now,
And I'd like to just summarize, just for anybody who I like to break it down occasionally, unpack some of what Justin's saying here for those of you who might not be so familiar. So the estate tax obviously applies to a certain amount that you could gift before the estate tax kicks in, right? There's a certain limit right now that's historically higher than it's been traditionally, and the talk that he's alluding to in these changes is either accelerating, scaling that limit back, meaning you gift less before the estate tax kicks in, or possibly even if none of that happens, there's a built-in sunset where it's going to get scaled back regardless, unless like he just said, unless it's extended. So things like the whatever you gift today is based off of the value today. So if the value of a private business, for example, is deflated due to COVID having really impacted the cash flows, the revenues, these are things that impact the value just mathematically. There's potential opportunities for people in that situation to gift not just before these limits potentially get sunsetted back or accelerated back. Just right now, due to COVID, there's sort of an opportunity. So I just wanted to summarize that before we go too much deeper. But no, continue, because I think I love the gift and how Justin's putting it, because depending on how proactive you are and how sure you are that tax implications are on the horizon due to a new administration, you might get very aggressive, but there's risks associated with these things. And something like gifting, where we know the sunset is set to, is it 2026, Justin?
Yeah, about 2026. Yeah.
It's set for that year anyway, unless extended. So we know that that's a relatively low risk thing that should be on people's minds, because whether it's accelerated or not, you should be thinking about this if you haven't been taking advantage of it. Talking to a CPA and an estate planner, your wealth manager, getting the team together, and those are the key components of this sort of problem. Making sure everything is set, the risks are being properly gauged and determined as well, because there is risk to certain strategies, gifting being one of the lower ones. So I'm glad we're focusing on it first.
And another thing you can do, like in supplement to this, or let's say you already used up a good chunk of your gifts. You use your 5 million, you have another 5.6 million left. Then, I mean, another strategy you can do is considering what is known in the industry. It's like an estate freeze. So you can create what's called you can do a revocable or a irrevocable grantor trust, which to set that up, I would discuss with your estate planning attorneys, discuss with your CPAs, make sure that the contract is properly drafted. And then in addition to gifting, you can even put an asset inside of a trust, which is basically a grantor trust, meaning that all the income and everything flows through to you. But for estate tax purposes, it's going to be, it's outside your estate. So what we call in the industry a defective trust. So you can then put a note, you can then have the trust send you a note for the value of the asset, which again, using COVID valuations is much lower. And then that asset can also grow outside your estate tax free. So with a combination of these two types of strategies, and let's say, especially with those asking like, oh, if I already used my gift, or I have assets that weigh like 40, 50 million plus, and I'm way exceed this 11, I don't think I'm going to get much benefit from it. There are a combination of ways that you can utilize not only this, but utilize other strategies as well. And especially now, since COVID values are low, it's a good opportunity to take advantage of this.
Absolutely, absolutely. No, I like that. I like that quite a bit, because, like we said, it's one of those relatively low risk things, and COVID is a situational event. So, how to take advantage of the situational event if it applies to you? Things like a private business, specifically small business owners, right? Is what comes to mind. If transferring these sorts of assets either into a trust or to the next generation is something that's on your mind, now is a very good time to start talking about these things and considering them seriously, not just as an idea, because at the end of the day, if we don't do something about it, time keeps passing, these things might change, whether it's the sunset or the acceleration of this. So I really like that element as well, that this is sort of a special situation that we're in, and if you could take advantage of it, we're kind of giving you guys the heads up now, explaining to you guys the benefits of potentially considering this, so you can get your team together. Reach out to us. That's why we do these streams. We make ourselves available through free consultations, second opinions. Take advantage. I honestly, I urge you guys, if this resonates with you, if this seems like it applies.
Absolutely. I mean, and I guess from there, if anybody has any questions, I'm always free to happy to answer if any questions come up during this. But again, this is definitely a good strategy to explore. Look at your businesses, look at your overall health of things. And even within your businesses, there's even existing advantages, existing tax situations like through COVID, through other incentives that you could take advantage of as well. And
Right,
not
right.
even like business, other types of assets that have declined. So just keep that in mind when you're going through. And that's the perfect time to have a conversation with your wealth advisor, your financial advisors, and all of that to figure out, which assets could potentially grow significantly, and that would be the best bang for your buck when doing this type of a strategy.
Yeah, yeah, and then like what Justin just alluded to, I'm one of the key things, especially if you've been following the live stream, that I talk about a lot is integrating professionals. So what he just mentioned is when we're looking at your assets from the 30,000 foot view, and we see, whoa, here are assets that are slated to grow quite a bit. Here are assets that might be low growth, more security. How you arrange all these things is a strategy in and of itself, because if you're going to keep things in your estate that might be lower growth, if you're going to pull things out of your estate, which is what Justin's alluding to, that might be slated for much higher growth, doing that before it grows means you're going to use less of your exemption when you do go ahead and give it, now or before it grows. So that's also part of that conversation, why it's important. I'm always preaching this, not handling things in silos, and dealing with professionals that, frankly, play well together and have these sorts of conversations. It's very important. More than you might expect is possible when the teamwork comes into play in a real way. So
Right.
I think it's perfect time. It's something you mentioned just to move the conversation along into. You mentioned the IRAs, 401ks, the conversion, right? Like, why don't you speak a little bit about that? I know that we had that on the plate for today.
Definitely, yeah. Before, just and one last thing that just came to mind before you get to that is
Yeah.
also with that whole freeze strategy, is that interest rates being at significant lows is also another opportunity to do this strategy, because you can get it. You can basically get yourself. You can have a note with very low interest, and then the assets can grow significantly outside your state while you're paying almost like nothing, where you're getting nothing in interest. So that's another opportunity, even though it's like a self charge, or if you do it through like a trust structure, that's another potential thing to look into, and
Right.
something we can also look into with this with your pension. So another strategy to get into would be this, the Roth conversions is what we mentioned. The big reason why, talking about this, and this is also is one of those like medium type risks, is because there are some changes on the horizon with this one. Is one, the rates, is the tax rates, and that's really the play when you're dealing with whether you should go Roth or whether you should go traditional. Is that, will the tax rates when I retire be much higher than when I'm funding the retirement plan, the pension, right, or the pension or your individual retirement right now? So knowing that in the proposals, they are mentioning of taking the current rate of 37% and hiking it back to the 39.6% rate, this could be a potential opportunity, especially with those high net worth individuals that are sitting on traditional type accounts, like either in their 401ks or in an IRA, to consider the potential of a Roth conversion. Now, of course, you got to run numbers and understand, asset mixes and all that are very important and key for this. But the big play right now is the rates, is the fact that you're at a 37% rate now, and then the rate could jump. So doing it next year, doing it for following year, could prove disadvantageous, because you're gonna execute the transfer at a higher rate. And those not familiar with how the Roth conversion works, is that if you're in a traditional type account, when you whatever you convert over, it's going to be an immediate taxable event to you, and likely that you're at the highest bracket. Let's assume you'd be paying tax at the ordinary rates of the 37%. So if you did it like later, let's say the rates hike, then you'd be subject to tax at 39.6%. So again, other factors they're talking about doing, especially with traditional accounts, is introducing this a 26% credit instead of a deduction. So that's another thing as well to consider in your planning, that if that does pass, to work around that as well. And why do I define this as kind of like as a risk, as a medium type of risk, is because who knows if the rates are going to, if everything will go through in Georgia, everything will go through with the planning and everything there. So maybe the rates don't jump right away, and maybe they don't actually go up. So that could be a risk. The second other risk about the Roth conversion is potential legislative changes is if they decide to change, how Roth in withdrawals are taxed. Because right now, if you take money out of a Roth, the earnings outside of this are going to grow tax free. So whatever you take out isn't going to be taxable to you. You're only going to pay tax up front on the principal amount, quote unquote, that you're putting in. Basically, let's say you funded it when you were 30 and now you're in your 40s and then you do the conversion. So the growth from when you're 30 to 40, the asset mixes and the growth on that will be taxable now. And then let's say from 40 to retirement age, that growth, if all successful and nothing changes in the law and everything remains the same, you can take that out tax free.
Right. Looks like we had a small technical difficulty. We'll get Justin back on here. I think it's a perfect time for me to sort of summarize for you guys as well my take on this sort of Roth scenario. So when it comes down to these different account types and having them available for as part of your entire asset mix, right? I want to emphasize the importance of understanding different strategies and vehicles.
Hello?
Yes. Okay, we have Justin back. 1 second. Let me switch.
Oh, you lost me?
Yeah, we lost you for a moment here, but when we get you back, I'll switch back to the stream, to the dual screen here. So the importance of understanding these sorts of vehicles, right? So if you don't understand what a Roth account is, which funny enough, a lot of people don't understand, especially if they've never participated yet. There's this whole taxes now, taxes later concept. I think we'll go into more depth in that maybe next stream, so to make sure you guys understand. But the point that I'm trying to get across is if you're not aware of these different tools, it's going to be very not attractive to you to pay a huge maybe tax bill today, especially if you're making a large conversion. And if you don't understand the potential benefit, right? If you have a very long time till retirement and you understand the benefit of one of these vehicles, you're going to be very happy and wanting to engage in a strategy where you might convert some non-Roth retirement funds into Roth retirement funds. And then once you're able to do that, what's going to happen is, as a wealth manager, and when I'm looking at your portfolio from the 30,000 foot view, I have more tools now to work with, right? We have taxable accounts, we have retirement tax advantaged or deferred accounts, and then we have the Roth accounts. How this ties into portfolio management, how your assets are distributed in all of these different types of accounts becomes very, very important. And I have so much more ability to do some cool things with your different asset mix, what goes where, how do we focus very, very high growth or very lucrative or potentially lucrative investments if they could go in a Roth, let's say, and then the growth of that is tax-free for retirement versus taxable accounts or tax-deferred accounts. You might want to take a different approach. But let's say you just don't even really understand the true value. You might just be looking at a very big tax bill today, and it might be very unattractive to you. And that's less tools sort of in my tool belt as wealth manager, working with a portfolio manager, working with your CPA or your planners, right? And I think that's why I'm happy that you guys are joining us. Please try to take these things into account. If someone's unclear on something, please give us drop us a line. I keep my eyes on the questions and the comments on our YouTube and our Facebook. We'll go ahead and answer any doubts you guys have, because it really is a crucial first step to being able to take advantage of some of these strategies. Same thing with the tax implications, right? You come to us for the design, for the conception, for the balancing of the risks, because you know how we were talking about different strategies carry different risks, where the gifting is a relatively low risk one, the conversion slightly higher for XYZ reasons. You don't have to make all of those decisions, but understanding the tools that are being worked with is going to make you so much more willing to make the right moves once you are relying on the right professionals and you reach out to someone like Justin or myself to tackle some of these bigger problems. So if you guys bear with me for 1 minute here, we have Justin on the line, but the video feed. I think he's gonna give me a quick call. Let me send him a message here. This is the beauty of live streaming. You know, you get everything. You get technical difficulties, bloopers, but you also get to interact. So it's my favorite form of interacting with you guys. So I think, yeah, if you guys hang on with me here for a moment, we'll get him back on. But I'm curious to know how many of you guys feel like you have a good grip on something like a Roth account and what the implications are to that, you know, and your wealth. Where
Hey, hello.
Hey.
Might have to reboot my computer, so just give me a sec.
Yeah, no problem. No problem. Once you got the video on, I'll be able to. Or we could also continue with just audio if the video's not working. So you just let me know.
You just give me 2 seconds. Yeah, I'm just gonna reboot it because I was realizing I was gonna tell you something's frozen when you were starting, and I didn't get to do that. So it's
all right.
good.
Perfect.
Now I'm gonna reboot this. What I'm doing is for the YouTube just so I can like get a monitor.
Okay.
So
okay.
I'm using my phone to kind of act as my monitor, and then be, you know, on stage my monitor, and then I have this. I have my
Okay.
So
come on in. Just give me a call once you're in, and we'll do it.
Get a Skype call. We'll do it.
All right. Perfect. So yeah, we'll wait for Justin. I'll go ahead and I'll review for you guys what we've talked about today first off, and expand on a point that I wanted to drive home for you guys. So we've been talking about tax planning. Justin was breaking down for you guys the different elements that are on people's minds right now for the end of the year, for upcoming tax changes on the horizon that might be a part of, you know, the new administration. And if, depending on how this Georgia election for the Senate seats go, the power to inflict or to do tax changes is going to be possible or very difficult. So that's sort of the basis for a lot of these things that we're talking about here today. So I want to, here we have, let me see, Emmy, great to see you guys. Anyone joining us on, let me see here. Emmy actually has a question. So we might wait for Justin on this one, but I would like to read her question. I have a little money I need to request in January from when I taught at a different state. It matures on my 55th birthday. The way I understand it, if I don't take it now, I actually lose money due to fees. But if I don't roll it into something else, I will have to pay a penalty because of my age. Do you recommend the IRA? Okay, so just as a disclaimer, right? This isn't personal advice. I know that you gave me a little bit of context here, but this isn't necessarily personalized advice that I'm going to give you here. This is just general advice for situations that you're talking about. So the key, if I understand what you're telling me properly, there's a certain limit and time. It's when you're at retirement age that you can start drawing from these accounts, right? Once what I believe you're talking about maturing is that you now have left that job, so the program is ending, right? You could roll it into various different vehicles. So there's, you know, the IRA, there's the Roth IRA. Like we were just talking about, rolling into a Roth IRA is going to carry an immediate tax bill. But depending on exactly what your situation is, how much time you still have to retirement going forward, it may make sense to take that tax bill up front. Okay, here we got Justin. Let me switch back over. Justin, can you hear me?
I can hear you.
All right, perfect. I could hear you as well. So we have a question from Emmy that I'll repeat to you. So she has some money she needs to request from when she taught at a different state. It matures on her 55th birthday. The way she understands it is that if she takes it now, she'll actually lose money due to fees, and I assume she's saying penalties. But if I don't roll it into something else, I will have to pay a penalty because of my age. Do you recommend the IRA? So what I was telling her is, obviously we're speaking in general terms through these live streams. Sort of our hands are tied for that reason. But you know, feel free to reach out to us also after the streams if you want to talk actual details and specifics. But let's talk a little bit about that sort of scenario, right? Because when a plan, let's say, ends, where she might have been in a 401 or 403b or 401k or something like that, where you have this period where you need to roll. There are stipulations around rolling into what. If you do a conversion to a Roth, we were talking about Roth specifically, there's that immediate tax bill due. So these are sort of the considerations, right? But maybe you could talk about this in a moment. Okay, she's saying they start charging fees after January if I don't take it. Okay, so she's in a position where she sort of has to make the roll.
Okay, right. So, I mean, the general rule of the roll forward is that you have 60 days from when you receive the funds to roll it into another type of retirement vehicle, where either if it's with a new company, you can do it with a new, or like a new school or a new institution, or if not, if that's not an option, then you would roll, your other choice would be to roll into an individual account. That way you would avoid the penalties, provided you do everything in a 60-day. You could possibly even see if they'll be open, instead of you having to cash the check, see if they'll be open to a trustee to trustee transfer. So that way it can qualify tax free. I mean, there might be other things that I have to look into, especially with 403Bs, but in general, I'm kind of talking with 401Ks when these types of situations and the plan shuts down, is that you have the 60 days, or else, as you mentioned, and you're not 59 and a half, you're going to get hit with a 10% penalty in addition to the taxes that you would owe on the amount.
Right.
So I would say do that. I would say you should explore immediately if you can a different type of vehicle such as an IRA. And if you have another company, maybe they will accept your 403. If it's another institution, see if they'll accept your transfer or roll forward.
Right. So yeah, basically it would be just a couple conversations, like he's saying. If you have some sort of new plan, right, you could speak to the administrator of the new plan, see if it could be rolled directly over. It saves you a little bit of hassle. There's always a scenario where they cut you the check, and then it's on you to, when you receive the check, deposit it within the time frame so that you don't run into issues, and then make sure that your CPA is reporting it all properly, and then you're all set. But what exact type and whether it's Roth or not, if you're going to do a roll, if there's going to be a conversion element to this, or if there's a new plan that could accept it, that's now starts getting into the specific details of your situation. And you start, there's different cost benefits that someone like Justin and myself would weigh out, together, a wealth manager, CPA, tax planner.
Right, and it kind of goes back to what I mentioned earlier with the fact of what tax bracket you're going to retire in. So you have to kind of think about that when you're doing that roll forward. If you just roll over from traditional to traditional, then what will be the plan? What will be the idea there? Now, 403Bs, there are different rules and different rules on the withdrawals. There's probably even other favorable benefits there. So you'd want to consider a type of vehicle that would be almost equivalent. So I think if anything, this is the time to have that conversation, look into this further. But again, you need to look at the plan will be, they'll say, look at your horizon, look at where you're going to retire, and look at the type of assets you can invest in this new type of plan. So that's also where you want to look, and that's another conversation with a wealth planner to see what type of vehicle allows some flexibility and what other types of investments you can use with other diversifications or whatever, or either risk tolerance too. So
Right. No, and I think it's a great time to make the point of while you were gone for a moment, what I was talking about is the ability. So as a wealth planner and a wealth manager, when someone has, let's say, Roth, traditional, taxable accounts, and they have these different vehicles to work with, more is possible. So just to give you a very obvious example, if you have 50 plus years till up until retirement and onward, where money might be invested, something like a Roth where something can grow for maybe potentially 50 years and that growth might be tax free, makes it very attractive. But if you never do the actions necessary to have that account under your belt and part of your assets, certain things become impossible, where we can't do these different when I start working directly with a sophisticated portfolio manager, where we say, hey, this is what they should invest in given their profile, but now how do we distribute things among different accounts? Well, if there aren't different account types to work with, now you're limited. That's a sort of more advanced strategy that heavily relies, like Justin's talking about, on the assumptions, on the profile, what you already have, that sort of thing are the key considerations. but having them available allows it to be possible. And like I said, educating yourself on things like the different vehicles is the first step, because sometimes a tax bill in the Roth scenario, a tax bill up front could be very unsavory. A lot of people might not want to do that. They'll see a certain amount from the traditional IRA go into a very much smaller amount, let's say, in the Roth IRA. But keeping the big picture in mind that the growth now will be tax free, you'll be willing to do that. You'll be actually happy to pay the tax bill. Maybe one of the first tax bills you'll be happy to pay.
Right, right, and it depends on, again, like the type of investment and the type of return on investment you can get, where you can pretty much, you can take advantage of it. So, and it depends on the type of assets you're using. So that's, again, conversation with your wealth advisor, conversation looking at your overall financial health. And I mean, there are ways, some of these retirement plans, you're not sometimes limited. There are ways you can get other types of assets, you're not just limited to your mutual funds. You're not just limited to your types. I mean, that all depends on the types of plans you are and the type of in their company. But in your IRAs, I mean, there are ways you could set it up that just go beyond just the stock market. You can do all types of investments, but again, of course, with certain parameters. But in
Right.
general, again, that's the conversation you'd have with your CPA, your advisors, and even with the fund administrator, the company, to find out what type of assets that you want.
Right, right, absolutely, absolutely, and like we said, we're here. We do the streams twice a week. Whenever you need us, we're available. At the very end, we will have also our contact information, or you could just reach out to me directly. We can figure these things out. Don't worry. It's just a couple conversations, like we're talking about, is sort of how you arrive at the answers for this sorts of problems. So, all right, I think it might be one of the last topic that you mentioned. I'd like to move on to. I know it's sort of, and we'll discuss it, but I know it's one of the more risky type discussions. But again, being educated on these things would make you much more likely and receptive to take advantage of them. Is the entities and the entity types and some of the differences that and potential changes that might come, right? Things like changing an entity type is no small business, right? So if the change is going to be made, you're likely not going to do it unless you're very clear on what the benefits are, what you're going to gain. So that's specifically what we're going to sort of discuss today. So Justin, I know you had a little bit to talk about, entities, how it plays with the potential changes, etc.
Right. Just to kind of give a little bit more of an overview on this particular topic, just so we can step back a bit before we get into what's going to come in the changes, is that let's talk about the general. You mean the general entity types? I mean, this is definitely a hot area, even before the end of the year, even when a new client comes on board, and they want to open a new business. Is what type of entity should I be? And a lot of the times, our general recommendation is, if you want flexibility in your type of entity, I mean, you could start with, let's say we start with an LLC. I'd say, okay, let's open up an LLC. LLCs, why, we do refer them a lot, is because of the fact is you can either choose it to be a corporate type entity, or you can be like a flow through entity. So for those not familiar with what I mentioned with corporate versus flow through, let's kind of go to what a corporate would be. So corporate would be is that the entity itself would pay a level of tax. So there's two levels of taxes. One at the entity level, where right now the corporate rate is the 21%. So whatever on the profits that you make of the company, it's going to be a 21% tax on that. Plus, if you do business in multiple states or in other states, you will have additional state taxes to pay, though you can get a deduction for the state taxes paid there. So that will affect your rate. But let's just say in our simple example that we're not going to take states into consideration. So you have 21%. And then when you get the money back from the company, let's say you want to draw the profits out of the company, you would then pay on those amounts that you draw from the company, which would ideally be after your taxes, will be dividends. So 9 out of 10, since you're in a U.S. company and you meet qualifications, you hold it for a certain amount of time, more than a year, etc. You hold it for a dividend period. You don't distribute within a certain period. There's certain rules. You meet the qualified dividends, and thus you are subject to a dividend tax at the top rate, which would be at 23.8%. But that rate can be variable. according to your brackets, and if you're subject to what's called the net investment income tax at 3.8%. So let's say we're going to talk highest bracket taxpayer would be a 21% corporate rate, then you'd have the dividend, and then you'd have a dividend coming out. So your overall effective rate would be ideally 39.8% after you consider the deduction for taking away the corporate tax, because you're not going to basically pay a dividend on whatever's not there. So that would be ideally where you'd end up. And the thing with corporations, a lot of people saying, is that the double taxation could be a big hit and surprise a big hit to people, even though it's an attractive low rate. So a lot of the times with companies and corporations, they have certain other types of incentives you can use, especially if you're doing business overseas and you're selling overseas, that the corporate rate could even drop further to 13.25%. And even if you're selling overseas, if you're conducting business overseas, it can drop even to a 10.5% rate. So with modifications. So that's one thing, is you have to look at your advisor with what types of entity, what type of business you're in. The other type of entity is a flow through type structure. And that would be at one level of tax. And you'd be subject to whatever on the profits. It would be as if you earn the money directly, your share directly. So whatever your tax bracket is, let's say, well, for this purpose, let's say your highest bracket, we get 37% today, you pay 37% on the profits. Now, an additional thing that's available for pass-through type entities, subject to certain limitations, and in specified businesses, like service businesses, don't get this type of benefit, and certain thresholds, then you could even benefit from a further 20% deduction on that. So thus your effective rate will go from the 37% down to a 29.6% rate. So that you have to consider those types of factors, as how frequently are you going to access your cash flow, which is really important for business, and also, the type of business you're in and how much flexibility you want in this. So talking with, other asset planning attorneys, you're talking with business attorneys as well, is, let's say, like, you're in a type of, if you're in a general business where everyone is owns the same, everything's pro rata, then, you could explore either option. But if you're in a business that maybe one person is kicking in a huge payment or a loan and only wants like a small percent, you want to customize the agreement, maybe doing a flow through type entity would be better.
Right.
And I don't want to get into that and it can definitely go into another session that we could just talk all about different types of things. So I think generally we'll start with that.
One thing that I sort of wanted to summarize for you guys is, because a lot of people, I know firsthand, I know you could attest to this. A lot of people just ask you, so what's the best entity? And they think there's just maybe an individual answer, but there's a couple key things which, sort of unpacking what Justin just said, come into play. Do you have an international footprint? What sort of arrangement in your business do you have with other players, other partners, etc.? What's the plan for the business? Is it eventually going to go to your children? Is that not the plan, etc.? What type of business? Like he said, it affects the tax type and that sort of thing. But also, if, like he said, an asset planning attorney, an asset protection attorney. We've had an asset protection attorney on here on a previous stream. I highly suggest you check it out on our YouTube page if you haven't, where we talked about from a legal protection perspective. So if the type of service you're in is a very high risk of lawsuit, or if you want to protect against that specifically, there's now going to be a balancing of maybe asset protection benefits and tax benefits. And so that's where that conversation comes into play. So it's not so simple as, oh, just what's the right type, period. Tell me the answer so we could fill out the paperwork. Well, listen, there's all these different things. Your footprint, international, domestic, what's the type, what sort of arrangements, what services, and what business type is it, so the legal risks, all these things, they all come together into a really good answer. But without discussing that, it's very hard, and then it could run into trouble later, that you didn't expect, just because it's one of those things that you really don't want to hurry. Speak with a CPA. An asset protection specialist might come into play as well. Your wealth planner, that's the kind of team in this sort of problem. I'm always alluding to, the components of specific problems. That would be the type of team you want to confide in. reference with when you're doing this.
Right, definitely. And then other things with a corporation, let's say, not forgetting even internationals, a lot of startup companies there, which we'll have to see what happens with this incentive once the new administration with all this comes in, is there's what's known as the small business stock incentive, especially with a lot of startup companies that are going to significantly multiply. So this could be some kind of another reason why a lot of them structure as corporations, because you can take advantage of this part of the code. So there's a lot of reasons, even just outside the general, there's a lot of very specific reasons of why, and the players and the type of business you're in, which does affect what we recommend. I mean, there's the other one we talk about with S Corp, which is almost very equivalent to the flow through type of entity that you'll see. The big benefit on those is that there's benefits with deducting your designating a salary, so that in the case of a flow through entity, an active type business, you'd be subject to your self-employment tax on all the profits. So using an S corp could be another type of vehicle you can look into to mitigate your self-employment tax and bring the numbers down, especially knowing that you could pay a fair salary. But again, that's another conversation you should have with your advisor as to whether that type of entity works for you. So before we, I guess, if John Paul got any other comments before we get to, the proposed changes on the horizon.
Yeah, I had one. We have one question coming in that let's go ahead and tackle it now. Lisa says, I have a question for Justin. At what age is it perhaps more appropriate to open a traditional IRA than a Roth? I know if you're in your 20s, it's probably better to open a Roth. Okay, yeah. I mean, I think you might have the right idea already. So I guess if you want, you could expand on that. I'll add any comments, if anything.
I mean, if anything, I say the earlier the better with retirement. I mean, I'm sure John Paul's going to echo that sentiment. The sooner you can, the better. And the good thing with Roth is that your bracket, your rates are going to grow. The thing with traditional is you have to watch out for like certain limitations on it, and that they'll limit your deductions allowed into the vehicle. And even with Roth, there's a certain phase out when you can do like a Roth IRA. So you have to be aware of those income limitations. And again, this is something that we have to look at specifically. So not a clear answer on that, but in general, let's say your company offers like a Roth plan for you. I mean, you should consider, it considers the type of asset, the type of expected growth, and again, the bracket that you're going to retire in. Because if you're in a high bracket right now and your company offers a Roth plan, I know you have much more flexibility with your 401k, you could possibly consider, well, why don't I switch my traditional? Because I don't think I'm going to be in a 37, 39%. I'm not going to be the highest bracket. I'm probably going to be somewhere in the middle. So then not only the advantage of a traditional is you get the deduction, you also get more money to invest. So that's more growth. The only downside with traditional type accounts is when you're at 72, they're going to force you, under the current law, they're going to force you to take them out. And maybe they could even change that law to accelerate R&D. So you have to consider other types of issues. And again, it's not just as simple as what works one way or the other. You have to look at your overall horizon, and then from there we can make a recommendation.
Yeah, exactly. Yeah, I think you already have the right idea, like I was saying, where, yes, there's rules of thumb that, you're a bit younger, assuming you're not. Another rule of thumb that Justin brought up, it's one of the big considerations, is what is your tax rate right now, and what is the expectation for the future tax rate. Knowing exactly what those are and having a really accurate guess as to what the future tax rate is makes these sorts of decisions much easier, because then you could sort of crunch numbers on the matter versus, say, just talking about the relationships of tax at the beginning, tax at the end, etc. General, younger is better, like also Justin mentioned. So there's also, if you're young, like maybe having the ability to do both as much as you can is also a good idea. Like I said, these will be tools. You don't have to say, we did this simulation and this is what I believe my tax bracket's going to be in the future. Well, a way of hedging against the volatility of life, maybe your whole world changes when you have children if you're younger, right? And then you don't do all those things with your career that lead to that huge tax rate down the line. So, there's also a sense of, even if you estimate these things, you sometimes don't go all in. That's some of the the conversations that are had by the professional saying, hey, we are projecting maybe 50 years out, depending on how young you are. Understand that there's some inherent volatility in a 50-year projection, so we might not fully go into a Roth, even if it's the mathematical, given our assumptions, best scenario. We're gonna risk balance, just like we're talking about in these tax strategies, balancing the risk side. Similar approach in making a choice like this. You're gonna balance some of those risks.
Right, and then the asset mixes too, what you put in each account could, especially when you're older, your asset, I mean, what I understand, your asset mixes are you completely change. So you have to consider that as well when you're in the retirement. Especially you don't want to have, generally, because now who knows what the rates are going to be and who knows what the laws are going to be. So you have to also, there's that little thing in the back of your mind and to think of that as well. So again, it's important to have these conversations with your advisor, even your wealth and your CPA. Integrate everybody into this process, because that's an important part for that.
Yeah. And just my one thing I wanted to add to that, the reason it's so important is because you can be doing something over here. Oh, I spoke with an attorney, or oh, I spoke with a CPA, or I just spoke with a wealth manager. And if you handled it in isolation, you might have a sense that you got it taken care of. But like we're talking about, these things can be complex. There's interplay in different areas of specialization, and you need to deal with a small team of specialists. So again, that's why we educate you guys here on this stream. That's why we make ourselves available. Please reach out to us. We're coming up on the hour. We're going to cover a bit more. Our contact information for the both of us will be on the screen. Don't be shy, because you need to have the right teams. That's why I keep alluding to, this is the type of problem, this is the type of team, not just go see this person, right? So keep that in mind.
And and then back to the finalizing what's going to change. So to be aware of your entity types. I mean, nothing, all this is proposed, and what they're talking about is that with corporations, let's go to that, is that they're looking to raise the corporate rate from that 21% I was talking about to 28%. And remember that qualified dividend, I was mentioning that it would be a favorable rate of the 23.8%. In addition, considering that with the capital gains rates, which there's also favorable, the 23.8% being at the highest bracket, they're looking to potentially get rid of those favorable rates, so that now you're going to be subject to the highest ordinary rate. And not only are they hiking the ordinary rate, they're going to keep the net investment income tax, which will put you in an effective rate on the dividend of about 43.4%. So you're looking, that's a big difference too, and that could definitely turn people off and wanting to go in a corporate setting. And eventually, it's also one thing, even with your stocks and your investments, is that maybe you also want to look at rebalancing portfolios was one thing I'm hearing clients are doing these days, is selling their highly appreciated, taking advantage of the low rate so they can do a rebalancing in their account. Something to definitely talk about with your advisor. So I'm saying do it, but definitely want to have that conversation and be on the horizon what's going on. And in addition to the flow-through entity, they're looking at potentially getting that 20% deduction, which was called the qualified business income deduction. They're looking at possibly getting rid of that, is if you make over $400,000 a year. So you'd be subject to the top rate, which would be the 39.6%. And in addition to other things like getting rid of, like reducing 1031 exchanges, and another potential thing when we go back to gifting is no step up in basis for your heirs, which is another thing that, we could get into a whole nother session about what happens after estate, what happens when you inherit assets, and what you should do with inherited assets, even from international and domestic. But again, this is another thing that's on the horizon as well. And so stay tuned for what's happening in Georgia. Stay tuned for everything with COVID, all the developments with the vaccine, because these are big things. Just keep watching the news, and that would determine possibly when we could see changes. And we're also keeping tuned and keeping track of what's going on.
Awesome. Yeah, I completely agree. And I think that's we'll be wrapping up here, but it's a perfect time to make the point of the situation's a bit fluid as well. That's why a lot of conversations, these are ongoing. We'll make plans today, and they're based off of projections for today. But when as your life is changing, as you're considering different things, different avenues, there's changes to your family structure, to your goals, to what you're dreaming of. that sort of thing. It might impact what you wanted to do with your wealth. Maybe that means we should be gifting now or later. Maybe that means we should be most likely gifting now in the gifting sense, but it might change what your future tax rate is, which affects certain planning, and then we might be agile. We might change course. So that's one of the key reasons it's important to be informed about these things, because you'll know when to reach out. And ideally, you're working with someone like us who's proactive and constantly trying to, just talk to a client. What's going on in your life? Because believe it or not, some of these subtle life things or struggles actually entail pivots, in your tax planning, in your estate planning, in your wealth plan, etc. So with that being said, I think, Justin, we've answered the questions we've got. I think we're going to be fading out now. I'm going to go ahead and wrap up. In a moment here, we're going to put our thanks for coming on. In a moment here, we're going to put our information on the screen. And again, to summarize for you guys, what we talked about today was tax planning, end of year considerations, what to do. There's different strategies given the potential tax changes on the horizon. Some of them are higher risk than others, given that we're not sure the tax changes are going to happen or when they'll happen. We covered things with Justin like, gifting, where there's a sunset in place that might be accelerated or not. You should really be considering gifting for various reasons. COVID, business valuations might be deflated, as Justin mentioned. I think is a great point, great thing that's situational and very current to talk about and consider right now. We talked about the Roth conversions being something that's on people's mind. We talked about entities. That's one of the more complicated topics, one of the riskier ones. But what the changes that might be on the horizon could really change the dynamics between different entity types. But and even maybe more importantly, we covered what are some of these key considerations on entity types in general. What are these things you should be considering, like type of business, structure, who's in the business, what's your goal with it? Are you in a high-risk potential lawsuit type business? So asset protection and an attorney in that specialization should be part of the conversation, along with the tax, weighing of different benefits and structures. So that concludes today's stream. On the screen right now, you'll see our contact information. Please take note. Don't be shy. Reach out to us. Again, this is the Wealth Management Show. Today you had myself and our special guest Justin from MBAF. He's a senior tax manager. His contact information is also on the screen. We'll see you guys back again with our normal scheduled programming for the show on Tuesday at noon Eastern Time. I thank you guys very much for being here. I hope to see you again on Tuesday. If you're on Facebook, please come on over to our YouTube channel and give us a subscribe, give us a like. We're going to keep coming at you with a bunch of content and live streams related to wealth management and all these key components, namely portfolio planning, tax planning, estate planning, asset protection, and financial planning is also a key component. So all of these things, experts in the different areas, you get an insight here for an hour each stream on how do these professionals work together? What problems entail serving or seeking out rather different types of professionals, whether it's the CPA, the attorney, the wealth manager, the financial planner, etc. So I'm glad you're here. I'm glad you're elevating your knowledge with us. Again, like I said, that's the first step in accomplishing some of these more advanced tax planning strategies or estate planning or wealth planning strategies that have huge benefits. So with that being said, thanks for being here. We'll see you again on Tuesday at noon. Have a great weekend, everyone.